The most dangerous events in financial history rarely begin with a scream. They do not begin with a press conference, a breaking news alert on your phone, or a panic on the trading floor. Those are the sounds of the crash itself. The true beginning, the moment the structural fracture actually occurs, is almost always defined by silence. It is defined by the quiet removal of a chair, the locking of a door, the subtle erasure of a service that had existed for centuries. If you have attempted to interact with the precious metals market through a major institutional bank in the final quarter of 2024, you have likely encountered this silence. A service that was a cornerstone of banking for decades, the ability to buy, sell, or store silver has simply evaporated. There was no grand announcement. There was no explanation. Just a void where a market used to be. Between September and December of 2024, a synchronized exit occurred. 8 of the world's largest, most powerful financial institutions quietly shut down their precious metals trading desks. These were not small, regional banks managing local assets. These were the architects of the global financial system, institutions that handle billions of dollars in daily flow. When entities of this magnitude simultaneously retreat from a specific asset class, it is not a coincidence. It is a signal. To understand the gravity of this moment, we must look beyond the press releases citing strategic realignment or digital transformation. We have to look at the mechanics of liability. In the world of high finance, banks are engines of profit. If a desk is making money, it stays open. When a bank voluntarily closes a revenue stream, especially one with centuries of history, it is because the calculation has changed. They are no longer looking at potential profit, they are looking at a catastrophic potential loss. They are seeing an event horizon that the retail market has not yet recognized. Over the next 26 minutes, we are going to deconstruct this exit pattern. We will examine the 8 institutions that have fled the silver market, the historical precedent that tells us exactly what this behavior predicts, and the terrifying supply-side mathematics that have terrified their risk management departments. This is not a story about trading. This is a story about the end of an era and the desperate scramble for the exits before the doors are sealed. Let us begin with the timeline. The evidence lies in the speed and the coordination of these closures. The first domino fell on September 12, 2024. TD Securities, a giant in the North American market, sent a routine account update email to its clients. Buried within the fine print was a notification that effective October 31st, Halloween, they would no longer offer precious metals spot trading. TD Securities had operated this desk for 37 years. It was a fixture of their institutional offering. To shut down a 4-decade operation with a mere 49 days of notice is not a standard business decision. It is an emergency amputation. It implies that the bank wanted to be completely flat, zero exposure before the end of the year. 2 weeks later, on September 28, the second domino fell, and this one carried the weight of history. Scotia Bank announced the closure of its Scotia Mocatta metals trading division. To understand the significance of this, you must understand the name Mocatta. The roots of this trading house go back to 1684. That is 10 years before the founding of the Bank of England. For over 340 years, through wars, empire collapses, depressions, and the rise of the Internet, this entity facilitated the movement of gold and silver. And yet, in the autumn of 2024, Scotiabank decided that 340 years of institutional knowledge and infrastructure was no longer worth keeping. They dismantled it in 90 days. The official reason given was a shift in focus to other commodities. But if you look at their books, they kept their base metals desk. They kept their energy trading desk. They specifically and surgically removed precious metals, gold, silver, platinum, palladium. This was not a retreat from commodities, it was a retreat from monetary metals. On October 3rd, the third giant moved. HSBC, a bank that has been a market maker in the London silver fixing since 1897, announced they were exiting precious metals storage and trading in North America. They gave their clients a strict ultimatum, 120 days to move physical holdings. If the metal was not moved, HSBC would facilitate a forced liquidation at spot prices. Think about the regression of that stance. After 127 years of market participation, they were effectively telling their clients, take your metal and leave or we will sell it for you. They were willing to burn client relationships to clear their books of physical liability. The pattern accelerated through October. On the 19th, BNP Paribas shut down their prime brokerage for metals. Prime brokerage is the engine of leverage. It is how hedge funds and institutional traders access the market with borrowed power. When a bank like BNP closes this window, they are stating clearly, we do not want to be the counterparty to your bets anymore. They are removing the liquidity that allows the paper market to function. By November, the contagion had spread to the retail and supply centers. Crédit Agricole, France's banking behemoth, ended options and swaps on gold and silver. They instituted what is known as a managed exit. They didn't ban spot trading outright. They simply raised the minimum transaction size from $10,000 to $250,000. This is a classic exclusionary tactic. By making the service accessible only to the ultra-wealthy, they effectively evicted 95% of their risk exposure while maintaining a facade of operation. Then the exit moved to the heart of the demand. On November 14th, Standard Chartered exited precious metals trading in Asia. This is critical. Asia represents approximately 60% of global physical silver consumption. Standard Chartered was sitting in the fastest-growing market with the highest premiums, and they chose to walk away. You do not close a business in a booming market unless you believe the merchandise itself is about to become a liability you cannot cover. Finally, the producers and the vaults were abandoned. Macquarie Bank, Australia's largest investment bank, closed their desk on November 28. Australia is a primary source of silver mining. Macquarie sat between the mines and the market. They had the most privileged position in the supply chain, and they abandoned it. And on December 6, UBS, the titan of Swiss banking, announced the consolidation of services, effectively cutting off retail and mid-tier access. When the Swiss, the guardians of global wealth preservation, start restricting access to physical metal, the message is undeniable. 8 banks. 3 months. One direction. What makes this silence so deafening is the market context. These closures did not happen during a price crash. They did not happen during a liquidity crisis. Spot prices were relatively stable. The waters were calm. But these banks are not looking at the water, they are looking at the radar. They are exiting during the calm because they know they will not be able to exit during the storm. We have seen this specific behavior before. The last time financial institutions of this caliber voluntarily exited a profitable market without external pressure was in the spring and summer of 2007. Between March and August of that year, 9 major banks shut down or dramatically reduced their subprime mortgage trading desks. At the time, the mainstream financial press called it strategic refocusing. The public was told the housing market was strong. But inside the risk management departments of Goldman Sachs, JP Morgan, and Deutsche Bank, the models were flashing red. They knew they were holding toxic assets that they could no longer price accurately. They knew that once the slide began, there would be no buyers. The banks that waited, like Lehman Brothers, found themselves holding the bag when the music stopped. Lehman filed for bankruptcy 13 months after the first wave of desk closures. The banks that exited early survived. They understood the cardinal rule of high finance: if you panic, panic first. So we must ask the question, what are TD, HSBC, Scotia, and the others seeing in 2024? What is the toxic asset? In 2007, the toxicity was a worthless mortgage bond that had no value. In 2024, the situation is inverted. The danger isn't that silver is worthless. The danger is that silver is becoming too valuable, and there isn't enough of it to cover the paper promises these banks have sold. This brings us to the data that never makes the evening news. The supply side of the silver equation is currently undergoing a collapse that terrifies mathematical modelers. The Silver Institute, the global authority on this data, publishes an annual report that aggregates every ounce of silver dug from the earth and every ounce consumed by industry and investment. For the last 4 years, the silver market has been in a state of deep structural deficit. A deficit means simply that the world consumes more silver than it produces. In 2021, the deficit was 51 million ounces. In 2022, it exploded to 237 million ounces. In 2023, 184 million. The projection for 2024 is another 215 million ounces. If you sum these numbers, you realize that in just 4 years, the world has consumed nearly 687 million ounces more than the mines have produced. To put that number in perspective, global mine production is roughly 830 million ounces a year. We have eaten nearly a full year's worth of global production from above-ground stockpiles. The banks know where these stockpiles are. They track the vaults, the COMEX in New York, the London Bullion Market Association (LBMA), the ETF holdings. The visible inventory sits at roughly 3.3 billion ounces. At the current burn rate, that sounds like 16 years of supply. It sounds comfortable. But banks do not model for today, they model for the curve. And the demand curve for silver has changed fundamentally. Silver is no longer just a store of value. It is the indispensable blood of the digital and green economy. It has the highest electrical conductivity of any element on the periodic table. It has the highest thermal conductivity. It is antibacterial. It is non-corrosive. You cannot build the modern world without it. Consider the solar industry. To build a photovoltaic panel, you need silver paste. In 2020, the solar industry consumed 98 million ounces. By 2024, that number hit 162 million. Analysts project 240 million ounces by 2027. This is exponential nonlinear growth. Consider electric vehicles. A combustion engine car uses maybe 15 grams of silver. An EV uses up to 50 grams. As global mandates force the transition to electric fleets, the demand for automotive silver is set to double in 3 years. Consider the rollout of 5G infrastructure. Every tower, every antenna array, every frequency filter requires silver. Every server in every data center requires silver. This industrial demand is what economists call inelastic. If the price of silver doubles, Apple cannot stop buying it for iPhones. Tesla cannot stop buying it for cars. They must pay the price because the metal is essential to the function of the product. The banks see this accelerating demand crashing headlong into a geological reality that we are about to explore. They realize that the billions of ounces of paper silver, contracts, derivatives, unallocated accounts, cannot possibly be honored if the physical metal is vacuumed up by industry. They are looking at a potential failure to deliver of historic proportions. They are closing their desks because they do not want to be the ones explaining to a client why their silver account is empty when the industrial giants have bought it all. They are leaving the table because the game is rigged against the house for the first time in history. But the demand shock is only half of the nightmare. To fully understand why these banks are running, we have to look at where the silver actually comes from. We have to look at the mines. And that is where the story turns from a supply problem into a geological crisis. To understand the full scope of this institutional retreat, we must look beyond the initial wave of closures in North America. The contagion did not stop at the Atlantic Ocean. It crossed into Europe, moved through the industrial heart of Asia, and reached down into the mining capitals of the Southern Hemisphere. The exit pattern is global, synchronized, and speaks to a structural fear that transcends borders. On October 19th, the fourth major domino fell, and this one struck at the very machinery of the market itself. BNP Paribas, a titan of European banking, shut down their precious metals prime brokerage. To the average retail investor, the term prime brokerage might sound like bureaucratic jargon, but in the architecture of modern finance, it is the engine room. Prime brokerage is how hedge funds, institutional speculators, and large-scale traders access leverage. It is the credit card of the high finance world. When a bank like BNP Paribas shuts down this specific desk, they are not just stopping a service, they are dismantling the infrastructure of risk. They are telling the market, we no longer wish to be the counterparty to your trades. They are refusing to extend the credit that keeps the paper silver market liquid. They issued no notice period for new positions. They demanded existing positions be closed or transferred within 60 days. This was a forced eviction of risk. By November, the strategy shifted from total closure to what bankers call a managed exit. This was the tactic deployed by Crédit Agricole, France's largest retail banking group. On November 2nd, they closed their derivatives desk, ending the sale of forwards, swaps, and options. But for physical spot trading, they did something more subtle and perhaps more revealing. They did not ban the purchase of silver, they simply made it impossible for the 99%. Crédit Agricole raised the minimum transaction size from $10,000 to $250,000. This is a gating mechanism. In the event of a currency crisis or a supply squeeze, the bank does not want thousands of retail clients clamoring for physical delivery. By raising the wall to $250,000, they have effectively insulated themselves from the public while maintaining a service for the ultra-wealthy, who are less likely to panic. It is a calculated reduction of liability exposure, ensuring that when the squeeze comes, the line at the door is short and manageable. Then the silence spread to Asia. On November 14th, Standard Chartered announced their exit from precious metals trading in their home market. This decision defies all conventional business logic. Asia is the beating heart of the physical silver trade. It is where the premiums are highest, the turnover is fastest, and the appetite for metal is insatiable. Asian demand accounts for approximately 60% of global physical consumption. In a normal business environment, you do not close your shop in the middle of the busiest marketplace in the world. You expand. You capitalize on the volume. Unless, of course, you believe that the merchandise you are selling is about to become impossible to source. Standard Chartered's exit suggests they foresee a disconnect between the paper price of silver and the physical availability of the metal in the Asian market. They are fleeing the region with the highest delivery risk. They are choosing not to promise metal to a market that actually demands to hold it. The seventh signal came from the source itself. On November 28, Macquarie Bank, Australia's largest investment bank, shut down their precious metals desk. Australia is not just a consumer, it is a producer. It is one of the world's premier mining jurisdictions. Macquarie had direct, multi-decade relationships with mining companies, refineries, and industrial users. They sat in the middle of the physical supply chain, with visibility into primary source material that few other institutions possess. When the bank that sits at the mouth of the mine decides to stop trading the ore, it is because they see something in the geology or the economics of extraction that the rest of the market ignores. They have access to the raw data of production, and their response to that data was to leave the table entirely. Finally, the pattern concluded in the fortress of global wealth. On December 6, UBS announced they were consolidating precious metal services. In corporate dialect, consolidation is a euphemism for exclusion. UBS is the largest bank in Switzerland. Switzerland is the final destination for gold and silver. It is where the world's metal goes to be refined and stored. When Swiss bankers begin to restrict access, creating a velvet rope that only those with $50 million in assets can cross, it is the ultimate signal that the era of accessible physical silver is ending. 8 banks. 8 distinct warnings. And the most chilling aspect is the market conditions under which this occurred. If you look at the price charts for late 2024, you will see a flat line. There was no volatility spike. There was no crash. The water was glass calm. But these institutions are not reacting to the weather of today. They are reacting to the hurricane they see on the horizon. They are exiting during the calm because they know that once the storm breaks, the exits will be welded shut. We have seen this specific choreography before. History offers us a dark mirror in the form of the 2007 financial crisis. Between March and August of 2007, 9 major financial institutions quietly shut down or drastically reduced their subprime mortgage trading desks. At the time, the public was told that the housing market was robust. The media was celebrating record highs. But inside the risk departments of Goldman Sachs and J.P. Morgan, the actuaries had realized that the assets they were holding, mortgage-backed securities, were toxic. They knew the borrowers could not pay, and eventually the mathematics would assert itself. The banks that exited early, the ones that sold their positions while the market was still complacent, survived. They offloaded their risk onto pension funds and unsuspecting investors. The banks that waited, like Lehman Brothers, died. Lehman waited 13 months too long. When they finally tried to sell, there were no buyers. In 2024, the banks are playing the same game, but the polarity is reversed. In 2007, the risk was holding an asset that would become worthless. In 2024, the risk is owing an asset that will become priceless. The banks are not afraid of the price of silver dropping. They are afraid of the price of silver decoupling from reality. They are afraid of being short a metal that they cannot physically acquire at any price. So what is the toxic reality of silver that these risk managers have identified? It is not a financial derivative. It is a physical deficit. We must turn our attention to the supply-side data, the numbers that do not make headlines but keep geologists and industrial planners awake at night. The global silver market is currently living through a math problem that has no solution. According to the Silver Institute, which aggregates data on every ounce mined and every ounce used, the silver market is in its fourth consecutive year of structural deficit. A deficit occurs when the world consumes more metal than the mines can extract. In 2021, the deficit was 51 million ounces, a manageable gap. In 2022, that gap widened to a chasm, 237 million ounces. In 2023, another 184 million ounces disappeared. The projection for 2024 stands at a deficit of 215 million ounces. Do the math. That is a cumulative deficit of 687 million ounces in just 4 years. To visualize this, understand that global mine production is roughly 830 million ounces per year. We have effectively consumed nearly an entire year's worth of global mining output from above-ground stockpiles. We are eating the seed corn. The skeptics will point to the inventories. They will say, but there are billions of ounces in the vaults. And on paper they are right. Above-ground silver inventories exist in 4 main reservoirs: the COMEX in New York, the London Bullion Market Association (LBMA) vaults, various exchange-traded funds (ETFs), and private reserves. The total visible inventory is estimated at roughly 3.3 billion ounces. At the current deficit rate of roughly 200 million ounces a year, simple division suggests we have 16.5 years of supply left. That sounds like a long time. It sounds safe. But this linear thinking is exactly what kills banks. Banks do not model linearly, they model exponentially. And the demand side of the silver equation has gone vertical. We have to stop thinking of silver as merely poor man's gold. In the eyes of modern industry, silver is a strategic element with no substitute. It possesses the highest electrical conductivity of any element in the universe. It has the highest thermal conductivity. It is antibacterial. It is the essential nervous system of the green and digital economy. The banks have looked at 3 specific sectors where demand is not just growing, it is exploding. First, the solar industry. Photovoltaic technology is dependent on silver paste to conduct electricity from the panel to the grid. In 2020, the global solar industry consumed 98 million ounces of silver. In 2024, that number swelled to 162 million ounces. Analysts project that by 2027, solar alone will devour 240 million ounces annually. This is not a trend, it is a revolution. And you cannot build a solar panel without silver. There is no alternative that offers the same efficiency. Second, the electrification of transport. An internal combustion engine vehicle uses a negligible amount of silver. An electric vehicle, EV, is a rolling computer powered by a massive battery array. Depending on the model, an EV uses between 25 and 50 grams of silver. As governments worldwide mandate the phase-out of gas cars, the automotive sector's demand for silver is projected to jump from 36 million ounces in 2024 to 67 million ounces by 2027. Third, the 5G infrastructure rollout. The high-frequency signals of 5G networks require silver-plated components to function: antenna arrays, filters, and circuit boards. Every new tower, every upgraded data center consumes silver. This brings us to a terrifying economic concept: inelasticity of demand. If you are a jewelry buyer and the price of silver triples, you might buy a gold-plated necklace instead. Your demand is elastic. But if you are Apple or Tesla or a massive Chinese solar manufacturer, your demand is inelastic. The cost of the silver in an iPhone or a Tesla Model 3 is a fraction of the total production cost, but the device cannot function without it. Therefore, these industrial giants will pay any price to secure the metal. They will outbid the investor. They will outbid the central banks. They must have the physical metal to keep their assembly lines moving. The banks see this. They see a future where industrial giants are draining the COMEX and LBMA vaults directly, bypassing the paper markets entirely. They see a scenario where the visible inventory of 3.3 billion ounces is rapidly locked away in solar farms and landfills, never to return to the market. They realize that the paper contracts they have sold, the promises to deliver silver that they do not have, are becoming a liability that could bankrupt them. If Apple and Tesla start standing for delivery, the paper game ends. But as terrifying as the demand shock is, it pales in comparison to the crisis on the supply side. Because even if the price of silver goes to $500 an ounce, the mines cannot simply turn up the dial. The geological reality of silver mining is the final nail in the coffin, and it is the reason Macquarie and Standard Chartered ran for the exits. This brings us to the second and perhaps most fatal variable in the bank's risk model, the geological peak. To the uninitiated observer, the solution to a silver shortage seems simple. If the world needs more silver for solar panels and electric vehicles, and the price begins to rise, surely the mining companies will simply dig faster. This is the standard model of supply and demand. It is the logic of the factory floor. If you need more shoes, you hire more workers and run the machines for a third shift. But a mine is not a factory. You cannot print silver. You cannot synthesize it. You are bound by the hard, unforgiving constraints of the Earth's crust. And the geology of silver contains a fatal flaw that makes it unique among all precious metals. The flaw is this: primary silver mines where the main objective is to find and extract silver, are a dying breed. They represent only about 28% to 30% of global supply. The vast majority of the world's silver, roughly 70%, comes as a byproduct of other mining operations. It is an accidental asset found while digging for copper, lead, and zinc. This creates a terrifying economic paradox known as inelastic supply. Consider the implications. If the price of silver triples tomorrow, rising from $30 to $90, a copper mine cannot simply double its output to capture that profit. They are mining for copper. Their machinery, their processing plants, their logistics are calibrated for the copper market. If the global economy enters a recession and the demand for copper falls, because we are building fewer houses and wiring fewer cities, the copper mine will slow down production. And when they slow down, the supply of silver collapses with it. It does not matter if the solar industry is screaming for more silver. It does not matter if the price of silver is skyrocketing. If the base metal economy slows down, silver production falls. The supply of silver is held hostage by the demand for lead, zinc, and copper. The banks understand this correlation perfectly. They know that in a stagflationary environment, where the economy slows, hurting base metals, but inflation rises, boosting silver demand, the market hits a brick wall. Demand goes vertical while supply goes horizontal. Furthermore, we are fighting the law of entropy. We have already picked the low-hanging fruit. In the 19th and early 20th centuries, miners would frequently discover high-grade veins where the rock contained huge percentages of pure metal. Today, those veins are exhausted. We are now scratching the surface of the earth for dust. The average ore grade, the amount of silver found in a ton of rock, has been collapsing for decades. We are processing more earth, using more diesel, and burning more energy to extract less metal. To bring a new mine online in the current regulatory environment takes an average of 10 to 15 years. It requires navigating a labyrinth of environmental permits, ESG, environmental, social, and governance mandates, and capital constraints. Even if a massive new deposit was discovered this afternoon, that silver would not reach the market until the mid-2030s. The banks have done the math. They see the deficit. They see the industrial vacuum sucking up the available float. They see the geological inability of the miners to respond. And this leads them to the final, most immediate reason for their exit. It is not just about supply and demand. It is about the law. When a bank sells you unallocated silver, or when they trade paper contracts on the COMEX, they are essentially selling you a claim check. They are promising that should you ever demand it, they will provide the metal. For decades, this fractional reserve system worked because nobody ever asked for the silver. Investors were happy to hold the paper and trade the price action. The ratio of paper silver to physical silver could be stretched to absurd limits, sometimes as high as 500 to 1. But what happens when the industrial users, Tesla, Samsung, the Chinese solar conglomerates, enter the market? These entities do not want paper exposure. They need the physical metal to run their factories. They stand for delivery. They take the metal out of the vault and melt it into paste. When the physical inventory drains away to satisfy industry, The banks are left holding millions of paper promises that they cannot legally fulfill. This is where the concept of UDAP comes into play, unfair and deceptive acts or practices. In the legal departments of TD Securities, HSBC, and Scotia Bank, the general counsels are looking at a nightmare scenario. If a bank continues to sell unallocated silver positions while their internal data shows a structural inability to source the metal, they are crossing the line from market making to fraud. If a client demands their silver and the bank says, "We don't have it, here is a cash settlement instead," that might work in a normal market. But in a crisis where the currency is failing and the metal is the only safe haven, a forced cash settlement is a default event. It opens the bank up to class action lawsuits, regulatory probes, and reputational annihilation. This is not a theoretical risk. It is a liability ticking bomb. The closure of these 8 desks is a preemptive legal defense. By exiting the market now, while the price is stable and the metal is still somewhat available, they are washing their hands of the obligation. They are telling the world, we are no longer the counterparty. If you want silver, go find it yourself. They are closing the door before the fire starts, because they know the theater is oversold and there are not enough exits for the audience. So what does this mean for you? What is the signal hiding in the noise? For the individual holding paper silver, ETFs, unallocated pool accounts, or futures contracts, the message is an air raid siren. The institutions that created these products are abandoning them. They are signaling that the mechanism of paper pricing is broken. When the disconnect happens, when the real price of physical silver decouples from the paper spot price, those holding paper will be left with a cash settlement that buys them nothing, while those holding metal will possess a strategic asset of infinite utility. The exit of Scotiabank, of HSBC, of Standard Chartered, this is the end of the era of abundant, cheap, financialized silver. We are returning to a market defined by physical scarcity. The pattern is activated. The insiders have left the building. The desks are dark. The phone lines are dead. The only question that remains is not whether the crisis is coming, but whether you will be holding the asset that industry needs, or the paper promise that the banks have just shredded. The window of opportunity to acquire physical metal at these suppressed prices is closing, not because of a price spike, but because of a vanishing act. The banks have made their move. They have secured their lifeboats by cutting yours loose. History will look back at the final months of 2024 as the moment the dam broke, even if the water didn't hit the town until later. The smart money has already evacuated. The silence you hear from these closed desks is not peace. It is the deep intake of breath before the plunge.